Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch, providing a 360-degree view of investor mandate activity across alternative investments, and PEVC Tech, a community for family offices, private equity funds, lenders, and VCs using AI and analytics to generate alpha. Vidrio Financial is a premier data management provider, shouldering the responsibility for your data from collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi. This is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Greg Brown, professor of finance at the University of North Carolina, Kenan-Flagler Business School, and founder of the Institute for Private Capital, will be our guest. So listeners have a high-level sense of our roadmap. We'll start with some background, then discuss his research as it pertains to investing. Investors should be able to extract a great deal of value from Greg's insight and research. On that note, welcome, Greg.
Thanks for having me. Excited to be here.
Great. Pleasure. Let's start with your background. That's a good place to begin.
Sure. Yeah. I'm finance faculty at University of North Carolina's Kenan-Flagler Business School. I've been in the academic research business for about 30 years now, and very interested in financial intermediation and things that are happening on sort of the cutting edge of finance, and especially the development of new markets, and have most recently been involved with efforts to try to promote research in sort of alternative investments writ large, but especially private fund investing. And really excited about the progress that we've made over the last decade or so. We've founded an institute that's sort of headquartered here at the University of North Carolina, the Institute for Private Capital, but it's really a multi-university effort. And the idea is to make it easier for academic researchers to do work in the alternative investment space. Historically, the biggest challenge has been that it's hard to get data. So unlike public stocks or even bonds, futures markets, things where you observe continuous prices and can kind of easily get reams and reams of data, it's very difficult. Anyone who works in this area knows it's very difficult to get large comprehensive data sets in the alternative investment space. So as an institute, we try to partner with people that have really good data sets and are willing to share them with academics, try to lower those barriers to doing new research projects. And it's been a really fruitful exercise. We've been able to generate a lot of interesting work over the last decade or so.
Yeah, as a practitioner and an academic myself, I couldn't agree more. In fact, one of the business entities I'm working on now, we're having that very discussion. So this is a very topical call. All right. Well, there are 4 areas of your research we'd like to touch on. One, the first is the risk-adjusted returns for private funds, then buyout GP deal structuring, then GP commitments and returns, and lastly, real assets and inflation, all of which are pretty topical. So let's start with risk-adjusted returns of private funds in VC and PE. So what was the objective of that research, and what are the headline or high-level conclusions? Or let's start there.
Sure. Yeah. I mean, I think just to set the plate a little bit here, there's always a first order question around what have returns been in any asset class. And again, if we think about public stocks or public bonds, it's super easy to calculate returns because you see a beginning price, you see an ending price, what cash flows happened in between. But in private fund space, you just don't see those prices, right? And so it becomes a real challenge, just a simple empirical challenge to figure out what returns actually are. You You can observe net asset values at the beginning of a quarter and the end of a quarter, but those aren't real prices. Those aren't prices where investors can transact. They're just values that are reported by GPs. So over the last, I would say 15 years or so, there's been a variety of different methods that have been developed to try to better estimate what returns have been for private funds. And there's a range of different ways of doing it. Some of them are fairly simple. One that's started to gain a lot of traction among practitioners and is, I would say, widely used by academics is the public market equivalent. And what you try to do is basically, generate a multiple for a fund that compensates for whatever the market did over that time period. So you can imagine, how much more or less would you have earned in a private fund versus investing in some benchmark public asset. And so, that's something that was developed by Kaplan and Shore, published about 15 years ago. It's a very nice measure because you can explicitly choose what you think the right benchmark is for a private fund, and then tell whether a private fund did better or worse than that. So it's definitely better than a simple multiple or an IRR that sort of don't account for what's happening in the public markets and what you would assume is sort of the opportunity cost of being in a private fund. And so it gives us a good sense of what performance has been. The downside is that you're sort of assuming that the fund that you're invested in has the same level of risk as the benchmark. And that may or may not be a good assumption, right? So let's take buyout funds, for example. Do you think buyout funds, in the sort of common financial lingo, have a beta that's more than 1 or less than 1 or equal to 1? And so we also would like to have some methods that tell us, what's the relative risk of different types of funds. It could be an individual fund, or it could be a sub-strategy of funds like, European buyouts or something. And then, of course, we look at things like venture capital funds, and I think most people would intuitively think that venture capital funds are riskier than buyout funds and quite risky, just given the nature of the businesses. But you need some method to figure out exactly how risky they are. So academics, through various methods, have made estimates of what the risk levels are of different types of private funds, and it turns out they're just all over the place, right? So some people estimate very low exposure to market risk, some estimate very high exposure to market risk, and we don't really have a sense as to whether that's being driven by the data that they're using, the time period that they're looking at, or if it's the particular funds or methodology that they're using. So we've just been working on a project just over the last year where we've said, okay, let's take all of the variables we can out of the equation. Let's use a common data set. Let's estimate these models over a common time period. Let's be very specific about the benchmarks that we're using. So use the same benchmark assets. And then estimate all these models and see what results they give. Do they give similar results? Or are they still as widely varied as what we've seen in the published literature? So that was really the goal of this study. Some of the really interesting punchlines out of it are that buyouts look to be about the same risk as the market overall. A lot of buyouts would be riskier than, say, the S&P 500 or some other broad index. But it turns out that if you as carefully as possible measure buyouts, they have about the same level, so a beta of 1. Some people say, well, that's, the methodologies are just, have a downward bias on their estimates. But when we take the exact same methodology and we estimate how risky venture capital funds are, then we end up with estimates that are much riskier, right? So we get betas that are more in the line of 1.5 to 2.5, a little bit more variation in terms of what different methods give. But intuitively, VC is riskier, we measure it as riskier. And so then these measures of risk, then we can do the proper risk adjustment for returns. And what we find, the kind of ultimate punchline, is that buyouts appear to have generated fairly substantial performance above benchmarks after properly risk adjusting, something on the order of 3 to 4% a year for U.S. buyout funds overall. Venture
is that the largest?
has higher.
Is in terms of, is that the that's sort of the average buyout fund, or it is like,
Yeah.
and then how does it look for small versus larger firms?
Yeah. Yeah, no, it's interesting that, so there's different ways you can do this. So what we do is in some sense, as a first pass, say if you invested in all buyout funds, what would your performance have been? So you can think of that as the closest you could get to a market index of buyout funds. And so that if you were to have invested in all buyout funds, the good ones, the bad ones, the mediocre ones, you would have earned something like 3 to 4% above the properly risk-adjusted benchmark for buyouts. Now, when you talk about dispersion, there is a ton of dispersion, right? So the best buyout funds are fantastic and the worst buyout funds are terrible. Much more dispersion than you see in, say, mutual funds, for example. Yeah, how does that vary by size? And we actually have a whole other paper that sort of looks at that. But it's interesting because the variation by size is not what most people expect. Most people think larger funds have lower performance. They do have a lower average performance, but that average performance is driven by the fact that there's more dispersion in performance for smaller funds. So that skewness kind of brings up the average for smaller funds. If instead you look at the median fund, say by size quartile, there's really no difference between small funds and large funds. So there's all these kind of little subtle points that you need to be careful about when you're doing these sorts of performance calculations. And obviously one of them is making sure you have your risk adjustment right. And then the other is thinking about how you think about what your investment opportunity set is. Large or small. If you're a large investor, can you invest in small funds? Are you able to write small check sizes, for example? And so I think these are the sorts of questions that we hope the research is informing.
Interesting. And you mentioned VC, or I know you've done some work on the same with VC.
Yeah.
And I understand the conclusion is quite different. Maybe you could talk about that.
Yeah. So when you do exactly the same calculations and you sort of figure out what the beta is for VC funds and then do a risk-adjusted return calculation, what you find is that even though VC returns are higher on average, the risk-adjusted performance is worse. It's basically zero or maybe slightly negative. And that's because there's so much riskier. You're getting higher return, but you're not getting enough higher return to compensate for the higher risk.
It's interesting because I would almost say it's the exact opposite of the prevailing wisdom, right? That
Yeah, I mean the VC market is sort of an odd market because it's access is constrained. So people who are successful VC investors, a lot of that comes from having long-term relationships with the top VC firms, and so knowing what the full distribution of performance is not super informative in terms of what your ability to achieve performance is, especially if you're a new investor. If you're able to invest in just the best VC funds, that's going to be a fantastic outcome for you. And we know that the types of investors like some of the larger blue chip endowments and foundations that have had long-standing relationships with the best VC funds, a lot of their superior performance can be attributed to those relationships.
Right. And again, the exception though, I guess, would be in line with the prevailing wisdom, which is if you can get into the top decile or quartile VC funds, those are producing excess risk-adjusted returns, I assume, right?
Yes, absolutely. And the dispersion, I mean, the dispersion is big in buyout funds. It's extreme in venture funds, right? And historically, the amount of variation across different venture funds is just massive. And so if you can capture some of that right tail, you don't have to have every venture fund be amazing, but if you can capture some of that right tail, that can have a huge impact on the overall performance of a venture portfolio, just because the extremes are so big.
Excellent. And I assume listeners and allocators and investors and GPs can all find your research on your site at the Institute for Private Capital.
Yeah, that's right. So it's uncipc.org. And all of our research is in the public domain. We don't do any sponsored research. It's all pure academic research that's targeting peer-reviewed journals. So we like to keep it as pure and clean and objective as possible.
Excellent. All right, let's move to the second topic. Let's discuss what you've learned regarding buyout GP structuring portfolios of deals.
Yeah. Yeah, so this is another really kind of dark space in the knowledge around how private funds operate. For, I don't know, more than 10 years now, we've had pretty good data at the fund level to be able to do research studies, but we're just now getting data on the holdings and kind of deal level data. And think about how many studies have been done on mutual funds or hedge funds or even individuals, how they create their own portfolios or trade portfolios and different trading strategies. And you can think of the giant literature on anomalies and factors and stuff. I mean, just none of that exists in the private market space. So here we're just after low-hanging fruit. We just want to understand how does a typical buyout GP think about putting together a portfolio of deals for a fund. There's a lot of different decisions to make, right? There's decisions about, how quickly do you deploy capital? How large or small do you want the individual deals to be? Do you want them to be diversified across, different sectors or geographies? How much leverage do you put on deals? So there's just so many different decision variables that we know really nothing about in terms of how GPs are structuring their portfolios. And you would like to think they're not doing it randomly. They don't just come across a deal and if they like it, they take it, and if they, at whatever terms are being offered, and if they don't like it, they pass. You'd like to think there's some sort of deliberate behavior going on to sort of maximize the portfolio aspect. And in fact, that's what we find. So we've collected a data set that has completely detailed, complete information on all of the deals for about 500 US buyout funds. And, we know what sectors these deals are in and how big they are and, when they were done during the investment period. And, we find some really interesting results. Maybe the most interesting one is that there does appear to be a trade-off between specialization and the higher returns that you would get from being specialized and the risk in the portfolio. So what we find is that more concentrated portfolios, either by sector, but also by geography, tend to have higher returns, but they also have higher risk. There's more variation in the performance of those specialized portfolios. So, that's a sort of a nice, intuitive, satisfying result for, a financial economist to be able to identify that risk return trade-off. Another one is that we found a little surprising, but I think there's good intuition for it, is that the largest deals that they do are actually the safest deals that they do on average. And that's a little bit different than what we see in hedge funds and mutual funds. If you see a mutual fund manager with a big position, that's them having a lot of conviction about that trade and really sizing it up, loading up the truck with what they think is a great trade. In private equity, it's a little different because you don't have as much flexibility for sizing the position, right? You don't really get to choose whether you're going to buy 20% of the company or 70% of the company. You're pretty much buying the whole company. Maybe you do a club deal or have some co-invest. So there's a little bit there, but it's kind of all or nothing in some sense. And so we think that this notion that the largest deals are the safest is GPs saying, okay, I want to do this deal, but I'm only going to do it if I'm not having to bet the ranch on it. So they're going to tend to do a little bit safer deals when they're large, so that they don't kind of through bad luck blow up the fund and blow up the franchise for the GP. So and we find that is a pretty robust relationship as you kind of go from the largest deal in a fund to the next largest, all the way up to the fifth largest. The deals get consistently riskier, but also the returns are higher. So again, we see sort of this risk return trade-off in terms of how GPs are sizing the deals inside of their portfolio. So
Yeah, does that beg the question if they should be doing more higher returning deals?
Yeah, yeah, and and that's another trade-off that they face is, there's probably some capacity that the GP has for the number of deals that they can do successfully, right? So, how many deals can a particular deal partner handle at one time? So maybe the right number is two or three, and so you can't do you know 25 high risk, high performing deals in a fund very easily, and because the amount of attention that it takes from a deal partner is kind of too much to do that many. That's a little bit more conjecture on our part, but I mean it
No, but
seems like
but you're right. Meaning it it's private equity is particularly if they're more involved operationally and or
yeah,
with the portfolio companies or actually adding value. Yeah, there are constraints on the scalability of
yeah,
the GP partner's time.
yeah.
So
Yeah, so this is very much, the first paper on this topic, not the last paper. I would say, like all good research, we've uncovered a lot more interesting questions than we answered along the way. But there are these sort of really interesting empirical facts that we'd like to explore more and get even more detailed data so we can say with some confidence that that's actually what's happening, and maybe there is some ideal size for a fund.
and was that research primarily domestic?
Yes. On that one, we were using the Burgess MSCI data on that. It skews very much towards the US. We did have global deals in the sample, but about 2/3 of all deals that are in our database are US.
Right. That's a nice segue into our third topic, GP commitments and returns.
Yeah.
What were your primary findings there?
Yeah, this is kind of a funny one. It's a paper we just did last year. It was a bit inspired by a Wall Street Journal article that we saw that was talking about how some GPs, especially junior folks at GPs, were having to take out second mortgages on their house to be able to meet the levels of GP commit for the funds that they were in, and this was sort of a change in power between LPs and GPs, that LPs were really expecting larger GP commitments to funds, and there was at least some anecdotal evidence that this was a bit of a cost or a surprise to some of the GPs. I'm sure not the old very successful ones probably didn't have a problem raising the money, but some of the younger one did. So it just led us to wonder, like, is there a relationship between the level of GP commitment and performance? That's not anything that had been studied before in the buyout fund space. There was a little bit of evidence in venture capital space, but again, pretty much a greenfield research area. So we were able to get data on about 1,500 funds, using data that Stepstone has, and the performance of those funds subsequently, and relate how large the GP commitment was to the performance. And what we found was that indeed there is a positive relationship between the level of GP commitment and performance of buyout funds, but only up to a point. So it's sort of an increasing function as you move up to around 10% or so GP commit. But if you get to these much higher levels, very high levels of GP commit, it kind of turns back down, and you start seeing a negative relationship between performance and GP commit. And the story there, I think this is a pretty intuitive story. It's that you're going to see incentive alignment as GP commit increases, but only up to the point where the GP has got too much skin in the game and they start getting risk averse. And if they got every egg in the basket of the GP commit basket, then they might be taking less risk than the LP would want them to take, and that seems to be reflected in the data. So we see this kind of nice interior optimal level of GP commit that's probably somewhere around 10% or so.
Yeah, that reminds me of seeding managers, which I've been doing for some time, including protege partners where our Treasury Secretary Scott also worked. One of the things we always wanted to see was skin in the game, significant material, but always had a view, not too much or all of it, because then they would make bad decisions, and they exactly what you're saying. So it's funny because this is the first time that I've actually seen a study that quantifies and what we've always suspected and or thought was optimal. So it's kind of it's nice to hear that.
Yeah, and again, this is like another place where there's definitely room for more research on this, because it's got to vary by, how established the GP is, what the mix of partners are. I mean, there's probably lots of important variables that we don't have the data on yet to be able to unpack. But I think just this kind of high level stylized fact that there does seem to be some, alignment up to a point is something that's valuable for investors to know.
Yeah, and the way you opened it up in terms of GPs increasingly having, like, the joke about their borrowing on second mortgages to fund their GP commitments. Yeah, I mean, I've invested in managers that actually, and then you have this whole that do that, help provide solutions to GPs to fund these commitments, and then of course you have the whole stakes business, which has grown from, which in my view is sort of the second generation of the seeding business. But in any case, the stakes business also to help managers fund these commitments.
Yep. Absolutely.
All right. Well, that's good. Let's go to the fourth and final topic, which is real assets and inflation. What should we learn there, or what have you learned there?
Yeah, I mean, so obviously inflation's been a big topic lately. We in 2022 we started getting inbound calls from people in our network asking us, well, first of all, what we thought was happening with inflation and how it was going to affect financial markets broadly, but specifically, were the sort of claims that people have made historically about real assets being a good inflation hedge. How is there empirical evidence to really back that up? And I think these questions were coming because we saw the real estate market just getting completely run over in 2022. And lots of people had claimed for a long time that real estate, it's a good inflation hedge. It's truly a real asset. You can touch it, and the ground's not going anywhere, and it should withstand inflationary shocks. So what we did was we collected a bunch of data on real estate funds and infrastructure funds, and then we essentially did essentially an attribution analysis to see how were the returns of those funds affected by the types of assets that were in those funds and the relation to interest rates. And importantly, what we did was we separated the change in interest rates into two components: the change in expected inflation and then the change in the real interest rate. And what we found was definitely surprising to us. We basically found that kind of core real estate is not a very good inflation hedge when there's a big swing in real interest rates, like we saw in 2022. I mean, you can sort of think of real interest rates going from roughly -2% to +2%, right? And
Is that just because of the lag? Because there's a lag in terms of their ability to pass through rental increases?
And that's exactly what we thought we sort of attributed to. As you think about sort of the duration of cash flows in a core real estate investment the same way you would the duration for a bond or something, and they're long duration assets, right? I mean, and so that real interest rate is going to have a huge impact on just sort of a simple duration type basis. And so as we moved into more speculative types of real estate investments, so you move into opportunistic and value add, then we started seeing that there was less exposure to the change in real rates and more exposure to the change in inflation. So the answer, like, is real estate a good inflation hedge? It depends, right? It depends on essentially what type of real estate it is. If it's established core, leased up, long term, can't adjust the cash flows, real estate, it's going to act like a bond, right? It's going to act just like a
Yeah.
30-year treasury or something, right? But if it's something where, you can reset the rents quickly, or, you're looking to, develop or improve property where the effective duration is much shorter, then, you're going to have at least a better chance of having some inflation hedging from it. And then we did the same thing for infrastructure. Infrastructure was actually a little bit better, especially private infrastructure provided a little bit more of an inflation hedge. Its performance was, at least during 2022 and 2023, much better than public infrastructure. So, like, for example, we compared returns between the Burgess MSCI private infrastructure funds, and then the MSCI public infrastructure assets. They have indices, and so there it was a similar result, in the sense that the public stuff didn't look like it was a great inflation hedge, and the private stuff did, and we were able to attribute that to not just the kind of duration of the cash flows, but actually the sectors that were being invested in. So, for example, if you look at private infrastructure, you see a lot of industrial companies in there, and especially a lot of service companies in industrial sectors. So you'd see, marine port service companies, or airport service companies, or other things that you might not think of as like a pipeline or the airport itself, but they're sort of adjacent to those assets. And especially in opportunistic and value add type of infrastructure portfolios, those did really well. I mean, they were some of the best performing funds of 2022 and 2023. So I think the lesson there for investors is, you really got to understand what you're buying if you're thinking about what the investment properties are going to be for assets, and that's true for kind of any sort of risk exposure, but maybe especially true for inflation, because inflation is very often, especially unexpected inflation, very often is going to be accompanied by a change in real interest rates. So you might have the perfect real asset, it's a building or a pipeline or a port or something, but if its cash flows are fixed over a long duration, the negative effect from the change in real rates is going to more than offset the change in inflation.
Yeah, and that reminds me of, I was a REIT analyst earlier in my career, and at the extreme right, you have like triple net lease REITs. Like, we took one of the first ones public, and they're, to your point, it's effectively a long duration bond because the cash flows are locked in over long periods, and the leasee bears all of the risk effectively. So it's really like a long-term bond. And then at the other extreme, you have hotels, which have the luxury of being able to reprice daily, so they can really price in that inflation quickly at the two extremes.
Absolutely. And I think, as we get more data on what's in private portfolios, we're going to be able to say more about, what are the attributes, what are the risk attributes of things in private funds versus public funds. And they are clearly different, right? You definitely don't want to think of private real assets as, the same types of thing as you're getting in public market real assets.
A non sequitur, but what's a favorite book or one you've read recently that you recommend?
Yeah, that's funny. I'm not a big book reader. I'm like a periodicals guy. So I'm just like insatiable.
What's a periodical you like that's perhaps relevant?
My favorite. I mean, this is so cliche, but my favorite periodical is The Economist. I just I love the satire and snarky tone of the Economist. I think they do a great job, kind of digging into the meat, very often on both sides of a discussion. So that's my Saturday morning is a cup of coffee and reading the Economist.
All right, so you're up on the Big Mac index. Got it. Okay, and what advice do you have for other allocators and investors, if any, based on your research and or what you've learned or discovered?
Yeah. Well, this is a very self-serving comment probably, but pay attention to what's happening in academic research and in the private market space. There's been so, I mean, you didn't used to have to pay attention because there wasn't any, but like now, there's lots of great researchers, lots of great young researchers in the prime of their career doing work in this area. They're doing things that I think are directly relevant to allocators and investors. I think they're also of service to policymakers because there's a lot of interesting policy questions around what we should be doing in private markets, especially, think about democratization or retailization, you want to characterize it, of private markets. And I mean, I think these are really important issues that that academic research can speak to objectively and in a way that helps both investors and policymakers make better decisions.
I think that's sensible, even if it is self-serving. What didn't we discuss that I should have asked you, or that you are with other investors? Anything else?
Yeah, I mean, I think there is this interesting existential question of private markets, which is, how big can they get in some sense, right? That there's been tremendous growth in the size of private equity, but also, expansion, private credit, basically didn't exist in its current form 15 years ago. We talked about infrastructure some. There's just a lot happening, a lot of growth in alternative investments. And the reason for that is probably logical, that returns have been on balance good, better than public markets. And so money moves in there. Money, I think, will continue to move in there, even though it's been a bit of a slow period the last couple of years in terms of new commitments. I think that's a cyclical phenomenon, not a structural one or a secular one.
Well, that's a function of lack of DPI, right?
Yeah, right. And so I think when things kind of the current situation kind of gets unstuck, then we'll go back to a fairly aggressive growth pattern. And other places like private credit have continued to grow. But I think there is a limit. Like, let's say, you hear people batting around numbers about how big private markets are, but let's just say, for the sake of argument, there's $10 trillion invested in private markets right now. How big can that get? That's probably well under 5% of investable assets in the world right now. So that doesn't seem huge, right? But what about 20 trillion? What about 30 trillion? What about 50 trillion? At some point, you are going to come to the limit of what's available in the private market space, unless we see a large unwinding of publicly traded stocks or assets. And I guess that's a possibility. I don't think that's going to happen. And even with the growth in private funds, if you look at, say, the stock market as a percentage of GDP, it's still very high. So we have fewer public companies, but they're larger public companies. The public markets haven't shrunk. It's just that the private markets have gotten more institutionalized. So how long can that go on? I think it's an interesting philosophical question in some sense. As an economist, I'm sort of interested in that. But investors should be interested in that too, because what happens when you start reaching that limit? Well, you're going to have less and less opportunity to earn alpha, right? I mean, the alpha is effectively going to get competed away to zero. And having some understanding of where that starts to happen, and it's not going to happen all at once in one strategy. It'll happen in buyouts at one time. It'll happen in infrastructure another time, and it'll happen in the U.S. at one time, and it'll happen in Asia another time. But I think those are things that the types of questions that we should be thinking about as well, not just kind of individual fund level things, but what's happening in sort of a more macro perspective with financial markets.
Totally. Great. Well, Greg, we'd like to thank you for the super interesting discussion and sharing your most valuable asset with us, your time.
Absolutely. It's been my pleasure, and look forward to doing it again sometime.
Cool. We'll definitely have you on a subsequent one. And in the meantime, we hope listeners have a better appreciation of the 4 topics we covered: risk-adjusted returns of private funds, GPs' portfolios, deal structures, GP commitments, and the correlation of returns, and lastly, real assets and inflation, whether they are or aren't inflation hedges. We all may benefit from this as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.